So the United States credit rating just got dropped from AAA to AA1 and stocks are falling after hours. On top of that, 1 year inflation expectations went all the way up to 7.3%, which is absolutely nuts at a time that consumer sentiment is absolutely in the tubes right now. A lot of people are very negative out there. And then we're going to go into United Health because I did recently buy call options on it and I pretty much timed the bottom of the market perfectly. So we're going to talk about what I plan to do with those calls and when I plan to take profit and all that good stuff. So I'm just going to be straight with you guys right now from the beginning of this video. This is going to be a raw video of me pretty much having a conversation with you as if we just pick up the phone and talk to each other of what I truly feel like is going on out there in the economy with this credit downgrade, United Health, consumer sentiment, inflation expectations, all that stuff. We're going to talk about it in a raw way, not edited, not trying to clickbait you into watching the whole video. Don't like, don't subscribe. Just listen because I have a couple $1 million in the market right now. You probably do too, or you want to get to that level right there. So we're going to break down what I'm looking at right now, what I truly feel like is very, very important to understand in the market because we're all here to make money. So let's start off on the credit rating for the United States. So as I tweeted just a little bit ago, right when this came out, Moody's downgraded the U.S. credit rating to AA1 from AAA. This is largely due to the national debt. And then I said, is this justified? And kinda it is. And then I said, hopefully this puts even more fire under everyone's butt to try to get the budget in check because a lot of this downgrading right here was because of the national debt and it's kind of getting out of control. So the main reason why we got this downgrade is because the national debt is kind of getting out of control. At a time that the economy is slowing down, we're collecting less tax revenue, and Trump is considering doing massive tax cuts, Moody's, which lowered the credit rating on the United States, they're basically saying we are cutting our tax revenue. So how are we going to bring in enough money to support our government? Either we have to bring in more tax revenue or we have to trim stuff in the government. And I get it that Trump is trying to do the Doge stuff, which could potentially help the national debt in the long run. But it's not really a huge needle move right now. I mean, they're saving a lot of money and it sounds like, billions and billions of dollars. But when you compare billions of dollars to the actual national debt, it's not really chipping at it at all. But yes, we're going down the right path of actually trying to get there. And the reason why the national debt matters so much is because the United States government is paying billions and billions and billions of dollars in interest to the people that buy the United States Treasury bonds. Right now, they're at roughly 4.5% for a 10-year bond. So every single year, the United States government is going to give you 4.5% return on your money for lending them your money. Now, if inflation happens to get out of control, which that is a threat with these tariffs, if inflation gets out of control, what do you think the Federal Reserve is going to do? They're probably going to keep interest rates higher for longer or potentially even raise interest rates. And when they do that, what do you think that means for the United States government that has to now pay out 5% instead of 4.5%? It's going to cost them way more money to borrow more money. And what they're going to do is they're going to print more money to then pay their interest bills on that money that they're lending back out. So it becomes this feedback loop of I'm going to print money to pay interest on this money, but as we print more money, we're going to cause inflation to go even higher. So the interest rates are going to keep going higher and higher and higher. And this is how economies and countries as a whole get totally wiped out because it's just this cycle of printing money to pay the interest on the bonds to keep everything in check. And the US dollar is a world reserve currency. So it's like, how do you default on your own currency? And it's not necessarily default. The issue is that we just print, cause inflation, and then you could just never get this thing in check. So that's why Jerome Powell at the Federal Reserve, he knows this and he's ultra focused on getting inflation down to 2% sustainably. But we just got the University of Michigan survey saying that 1 year inflation expectations from right now are going to be at 7.3%. Now, full disclosure, I think this is absolutely nuts and I don't think inflation is going to get to 7.3%. But imagine if it would get to 7.3%. And then maybe Jerome Powell at the Fed is going to raise interest rates to say 7%. And now they're going to pay from 4.5% on a 10-year bond to just say 7% on a 10-year bond. So that's then going to make it much harder for the US government to pay the interest on the bonds that they issue because it'll go from 4.5% to 7%. So that is an issue if it truly goes to 7.3%. Now, this morning when that data came out, the market didn't really react too much to it because it's just a University of Michigan 1 year inflation expectation survey. It's just one survey. And honestly, these surveys often get blown out of proportion and there's often a lot of political bias in this. So if you're a Democrat, you're going to say inflation is going to go higher because you want to make Trump look bad. But if you're a Republican, you're then going to say you feel like inflation is going to go down, so it makes Trump look better. So if we balance that out, you would expect this to be roughly 2%, but it came in at 7.3%, which is honestly pretty bad. So if we go to 7.3%, we're probably going to be in trouble, but I highly doubt it. And I was just talking about this with my Discord people earlier today, and I said, I bet you that inflation does not get over 3% for all of 2025. and I was willing to bet anybody on that. And honestly, it's a good bet if you want to take it because right now we're at 2.4%. So I don't really have much of a buffer there. So I'm expecting the next couple months of CPI inflation to maybe be a little bit hot. But then as the months trend down, because that's going to maybe be part of the tariff bump or the tariff influx of goods that are coming in. But after that, I feel like it's going to continue to trend lower and lower and lower because we have this massive tailwind in the economy to potentially lower inflation. Number one, because of AI and tech that's making things more efficient. But number two, because one of the big factors in the CPI inflation data is oil, and oil is actually going down quite a bit. So that's probably going to drag down the CPI number. So whatever this tariff bump was going to be, it's probably going to be offset by what's happening with oil, which of course that's pretty good. And I get it, I'm probably boring you with this video right now, but if you're a true investor and you really want to understand what matters in the economy right now and how to make money, you have to understand this stuff because interest rates are like gravity on the stock market. If interest rates go up, stocks are typically going to fall. And if interest rates go up, that's bad for the national debt. And maybe our credit rating will go even lower based on a national debt becoming even harder to service, meaning it's harder to pay the interest on the bonds that we have to issue to make the government survive. So it all comes together. Inflation expectations, the government, the US national debt, all this stuff, it all comes together. This all matters a lot. So let's talk about the consumer sentiment survey here super quick. So we just got the main numbers, which came in at 50, which you could see just a few months ago in December when the market was pretty much going straight up. The sentiment was very high. The sentiment went all the way up to 74. Now it's at 50. So the question is this, because the stock market went down and we have this tariff threat, everybody is freaking out about the economy and the stock market and stocks are down. But we just got this massive rebound in the stock market, but this data right here is not really reflecting too much. And I know exactly why. And we're going to show you that in the next chart, which is right here. So this is a chart of the fear greed index. And honestly, it's one of the most important charts to understand how to make money in the market. Let me move myself out of the way a little bit. So the blue line corresponds to the fear greed index, and it went all the way down to a level of 4 on April 7th of this year. Now we're all the way up here to a level of 70, meaning we're in the greed category right here, and we're in the fear category right here. And I always said time and time again on this channel, you want to be greedy when everybody is fearful. So down here, this is when you want to be greedy and buy. But now people are being greedy right now. So this is when you want to be fearful. But the reason why the consumer sentiment survey is still bad is because most of the people were too scared to buy into the market down here when we were extremely fearful and when the market was on this dip right here. By the way, the orange line right here corresponds to the S&P 500, and this is a 3-year chart. So the market dipped, everybody was freaking out, they all bought it on the top and they buy high and they sell low like most people do. So they're freaking out, they sold right here, the market went up a little bit, they're like, oh yeah, the market went up, maybe I'll buy in, then it goes back down, and they're like, oh yeah, good, I didn't rebuy back in. But then the market made this massive run right here and most of the people missed out. So most of the people that did miss out, their sentiment is still low because they're all upset that they didn't buy into the market and they're sitting on the sidelines, and now they're debating like, well, the market's going straight up, maybe I should buy back in, but really I don't know because now we just got degraded on our credit rating and inflation expectations are going through the roof. So sentiment is still down even though the market went up, but eventually consumers will capitulate and they're going to buy into the market just like they bought into the top right here. And then the market will take a little bit of a breather and fall down into this category right here, and then they'll panic sell again. So this is a typical cycle that most people follow. They're still bearish up here and they want the market to be completely perfect and they want to buy in when everything is just right. But I promise you, the market is never going to feel just right to buy into. There's always going to be something to worry about, like the credit rating got degraded, valuations are a little bit lofty, trade wars are going to happen, inflation's going to go up, whatever it may be, there's always going to be something to worry about. And trust me, I go on so many spaces on X where it's basically just like a live chat room where you talk to a bunch of other people, and people that have big accounts that are expected to be the experts in the finance field. You would be so surprised how they were completely freaking out in the market when it was on this dip right here. People were saying, I'm putting my entire net worth in gold, I'm selling my house, I'm selling my stocks, I'm getting rid of my bonds because the US government's going to default, all this crazy stuff. Right here at the bottom of the market, they put all their money into gold. But gold is a risk-off asset, meaning when everyone's freaking out and selling their stocks, they put their money in gold as a safe haven. But they did that at the complete opposite time. Gold pretty much peaked out in this time period right here. But then when the sentiment flipped and Trump started doing 90-day pauses, made a deal with China, and all this good stuff is going on now, the stock market is now ripping higher. So it just goes back to that typical cycle of people loving the market when it's going up. A lot of them FOMO into the top right here. As it goes down, they panic sell and lose money. And then once it goes back up, they'll FOMO back into the top, expecting it's just never going to go back down. But you don't want to be like that. You want to be greedy when other people are fearful. So down here is when you want to be greedy, not up here. Now, if we go to United Health stock super quick, you could see that it made a massive, massive drop. This is just a 5-day chart, But let me show you a year-to-date chart where it's down 42% year-to-date, and it was all the way up here at about 600 bucks per share, now at 291. And we're going to go back to this 5-day chart because I want to give you a lesson here on what a lot of people really mess up. So in Discord, I literally timed it perfectly where 255 was where I bought my calls and my strike is a 260 strike for about a year out. And a lot of people were skeptical in there saying, oh, I don't know if I want to buy those calls because they just look at the chart and they see this, where it's just pretty much going straight down and they're like, oh, it's just going to keep going down forever and ever and ever. But I'm sitting here thinking like, this is the largest health insurance company in the entire world. And yes, they're getting hit with potential fraud. They're getting hit with a potential higher Medicare costs. If you just go to the website, United Health Investor Relations, they did a 30-minute press conference talking about what's going on. And essentially, this is their plan. Their plan is for 2025 to stabilize the company again. In 2026, they expect to get back to growth and get back to their profit margins that they're used to doing. How are they going to do that? Well, they're probably going to raise prices and they're probably going to trim the benefits on insurance policies. And I was talking to my Discord people about this earlier today, and I was like, if United Health is going to get hit with higher than expected expenses from healthcare payouts, the other insurance companies are probably going to get hit by that too, because it's kind of like an airline. If the cost of jet fuel doubles, every single airline is going to be affected by that, and they're all going to have to raise their costs for flights. So it's like, if all these people are just utilizing their health insurance more, all the health insurance companies are either going to raise their prices or raise their deductibles or just make health insurance harder to use. And I'm not saying this is the right way to do it, but maybe it's going to cost you $1,000 as your deductible to go to the ER instead of $100. So maybe when you feel like you have the flu, which by the way, right now I am kind of sick. That's why I sound kind of crappy right now. So yeah, it's like if you have $1,000 deductible, you're going to think twice before going to the ER for that flu. You're probably just going to stay at home and take NyQuil and just go to bed, whatever you decide to do. So again, I'm not saying this is the right way to do it, but this is what they're all going to do. They're going to slowly trim back the benefits of the health insurance so that they can get back to the profit margins. So I feel like right now is a decent time to buy into United Health. But remember, the market's forward looking by roughly a year. So once we get earnings that come out, maybe like earnings 6 months from now, they're going to be guiding a year forward. And they're probably going to say, yes, Q1 was bad, Q2 was bad, and Q3 was decent. But Q4 going into 2026, it's probably going to be okay. And we're probably going to be just fine. So once they say that on their earnings call, the stock is going to be probably close to all-time highs again because the market's going to immediately go and price that back in. So that's why my calls, I have a 260 call, I have a couple contracts of it. So again, very, very small part of my portfolio. And this is, of course, very, very speculative. And the money that I'm putting in these calls, I am expecting to lose. And that's just the expectation I'm setting with people. But I do feel like the risk reward down here all the way at 291, even at 291 right now, I'd probably do it again. I think the risk reward is there, but you do have to be patient. This is not going to go green every single day. We're probably going to see days where it goes down 10% in one day still. But if you be patient and hold on and you close your eyes for 1 year and you wake up a year later, I would be very surprised if this is not back to $500 a share or higher, because they will get through this. There's just a lot of negative sentiment out there in United Health right now. So that's why I'm bullish on it. I like to be bullish when everybody is bearish. Just like the stock market when I bought the dip in April, that's how you want to be on United Health right now. And of course, no guarantees, and it could actually be a lot worse than what we're thinking. So that's why when I buy these calls, it's a very, very small percent of my $2 million portfolio. You always want to keep your ratios in check when you do speculative plays on the stock market. So of course, it's working out good right now, but maybe it won't work out good going forward. You just have to have a plan in both situations if it works out good or it works out bad. If it works out bad, you're okay because again, it's a very small percent of your portfolio, but if it works out good, great. I might be able to turn that $15,000 call option into $100,000. I mean, we'll see what happens, how high it actually goes from here, and if we're going to be patient with it or not. We have to see how things materialize going forward. A lot of the trades that I do, I love selling put options because honestly, selling puts, it's just so much easier to sell puts on companies that are trading below intrinsic value, that have a moat, that have pricing power that I'm okay to hold for a long run. Selling puts is like a cash flow machine, and I've been doing this for years, and I generated millions of dollars in my account, thousands of dollars every single month in option cash flow. So if you want to learn how to do that, click the link below, and you're going to come to my website right here. It's going to walk you through what you're going to learn if you do my course and come into Discord. And the best part about it is that it's all under one subscription. The reviews are great. Go through and flip through all these reviews right here. You could scroll through this right here and see everything that you're going to learn, exactly what happens after you enroll. So click here. It'll take you straight in. It's monthly subscription, so you could cancel whenever you want. But I strongly recommend you check this out. It's going to completely change your life. You're going to see all my trades, all my breakdowns, all my Zoom calls, all that good stuff. You're going to get totally blown away about what happens in this Discord here. So I'll see you guys in there, and I'll see you guys in the next video.